Turning back to the major averages, joining us now is Aadil Zaman, partner at Wall Street Alliance Group. And Aadil, your reaction to today's market close after this morning's, I would say, mixed jobs report?
Great to be with you, Ken. So we feel that it's been a little bit painful this week, and we feel that the Omicron variant is going to create a lot of uncertainty in the market because there's still so many things that are unknown about it, and market hates uncertainty. Added to that, we are long overdue for a correction in the market, so this sets the tone for a pullback in the market. And if you look at the Omicron variant, United States, we are in a relatively better position to be able to deal with it. But even the COVID death rates in the US recorded in 2021 have surpassed 2020 levels. Now think about some of the low-income countries where the vaccination rates are in the single digits. Those countries would be especially vulnerable. So we feel that this market is setting itself up for a correction here.
All right, so just back on the jobs and Omicron, because today's jobs report was, I would say, lackluster, but the unemployment rate did fall marginally to 4.2%, but risks remain that could reverse the progress the labor market has made. So do you think December jobs will be impacted by Omicron, or is it too soon to tell for that?
I feel that Omicron has already started having an effect on that because even if it doesn't come in the US, the perception of it could play on people's minds, and some people may just feel uncomfortable in going back to work. And already we are seeing Google delay its back to office. Other companies are going to do the same. So we feel that it is very likely that the already depleted job labor force could further deplete because of Omicron perception, and that could increase the competition amongst employers for the workers. And that could drive up wages, and that could further increase the inflation into the market, and a higher inflation could be problematic for equities as well.
Now, the Omicron variant has weighed heavily on investors this week. You mentioned it, there's a lot of uncertainties, and investors do not like uncertainty. Do you think that the variant could continue to impact the markets, and is this going to be a week-by-week basis or day-by-day?
We do think it's going to be a day-by-day thing, Ken, because if we think about it, inflation is already a problem, right? And finally, we have Fed Chair Powell also acknowledging that the word transitory should be retired. Now, if Omicron could have a negative impact on the global supply chains, which are already very strained, and if for some reason the variant spreads to Asia or places like China where they have a zero COVID tolerance, or places like Vietnam where you are already coming out of a very difficult third wave of COVID, and these regions go through lockdowns, it could possibly mean that the supply chain issue could get worse, inflation could get worse, and market could have increased volatility here.
Now, lots of stay-at-home stocks were some of the worst performers this week, suggesting that investors are betting that the U.S. won't institute another shutdown over the Omicron variant. What are your thoughts at the stay-at-home stock performance this week?
So we do feel that U.S. is not going to go through another lockdown, and we do feel that the U.S. Would be in a position to come out of this eventually, and so we are constructive on the market as a whole. But the areas that we are more constructive on, as opposed to the stay-at-home stocks, would be, for example, if you look at the healthcare space, we feel that right now we are going through a golden age when it comes to pharma, where the only weapons that we have against this war against viruses is companies that give us the tools to be able to make medications and vaccines. So we feel that there's going to be more investment in that space, and that's going to benefit some of the pharma companies. Specifically, we like Johnson & Johnson, Pfizer, Merck, not only because they are a good virus play, but also because they have diversified portfolios and they also pay a good dividend.
Now, we also heard from Fed Chair Jerome Powell this week saying that inflation should no longer be called transitory and signaling that they could move up their asset taper timeline. It's sort of a clear inflation is here to stay comment. So your thoughts on the Fed's announcements and whether we could see inflation deep, and we're talking deep, into 2022?
Yes, we do feel that inflation is here to stay. It's ironic that Fed Chair Powell would first get selected for the second term and then start talking about let's retire the word transitory and focus on inflation. But we think that we've been calling for sticky inflation for a while. And a lot of this inflation is extremely regressive because if we look at fuel prices, they have gone up quite a lot. And we don't see an end in sight for oil prices going up, and that is again going to cause inflationary pressures. So we do feel that this inflation is going to continue well into 2022. Oil has temporarily come down, but the global demand is too high and the supply is constrained because of because of Biden administration's discouraging fossil fuels. So we feel that that is going to be a factor amongst others that is going to keep inflation high, and the Federal Reserve does have no choice but to start raising interest rates sometime, we feel, in 2022.
So as we head into 2022, what sort of headwinds and tailwinds are you watching out for?
Well, we generally feel that this market is in a long-term uptrend. But we feel that recently, we heard Charlie Munger say that the market is overvalued, and this is worse than, even crazier than the dot-com bubble. And we feel that one of the things that we are watching is that a lot of investors, their portfolios tend to be overexposed to technology right now because over the past decade, technology stocks have gone up so much, right? And we feel that, you know, if you look at Nasdaq, when the tech bubble burst, after that it took the Nasdaq nearly about 14 years to come back to its original level and recover. So what we at Wall Street Alliance Group, we do wealth management for high net worth clients, and what we are actively always advising our clients that going into 2022. We have to make sure that we are not over leveraged in any one stock, overexposed in any one sector. Portfolio rebalancing and diversification becomes very important here.
All right. Aadil Zaman, partner at Wall Street Alliance Group. Aadil, thank you so much for joining us and sharing your wisdom and insight.